Someone on the internet told you to become an S-Corp and save 10 grand on taxes. But for a lot of freelancers, that exact advice quietly cost them money instead. And by the end of this video, you'll know the single profit number that decides which group you're in. So where does the math actually flip from costing you to paying you? An S-Corp can genuinely save self-employed people real money, but only above a certain profit level. Below it, the cost of running one eats the savings whole. By the end of this, you'll know your number, you'll see exactly where the lines cross, and you'll walk away with a clear do it or not yet. No hype, just the math. Elect too early and you'll burn $2,000 a year in payroll and filing costs for savings that aren't there yet. By the end, you'll know exactly when that flips into your favor. One disclaimer up front because it matters here more than usual. This is general education, not tax advice. Run your real numbers with a CPA before you elect. First, what an S-Corp is and isn't. An S-Corp is not a different kind of business. It's a tax election you put on top of your LLC. As a regular self-employed person, your net profit gets hit with self-employment tax. That's Social Security and Medicare, 15.3%. And here's the detail most people skip. That tax doesn't hit your whole profit. It applies to 92.35% of your net earnings. On $80,000 of profit, that's still a real chunk before income tax even shows up. Here's the move. Elect S-Corp and you split that profit into two buckets. One bucket is a reasonable salary you pay yourself. That part still gets the full payroll tax. The other bucket is a distribution, your profit as an owner. And that part skips the 15.3% self-employment tax entirely. Same $80,000 in your pocket. Only part of it gets taxed for Social Security and Medicare. For this example, say you pay yourself a $50,000 salary and take the other $30,000 as a distribution. That distribution bucket is where the savings live. Here's the math done right. That $30,000 distribution would normally be SA taxed on 92.35% of it. About 27.7, and 15.3% of that is roughly 42.40 you don't pay. So the real headline isn't 10 grand, it's about 4,200 before income tax effects. But notice, nobody who's hyping this has mentioned the cost yet. That's the part that decides whether this is actually worth it. An S-Corp isn't a checkbox. Once you elect it, you have to run actual payroll for yourself, which usually means a payroll service. You file a separate business tax return, the 1120-S, on top of your personal one. Most people hand that to a CPA, and a few states tack on franchise taxes or fees just for the privilege. None of this is optional once you're in. Add it up, and the realistic ongoing cost runs somewhere between $1,500 and $3,000 a year, every year. Let's use $2,000 as a middle-of-the-road example. So the real question was, never does an S-Corp save money. It's, does it save more than $2,000 a year? Everything comes down to that one comparison. At $80,000 in profit, the savings win about $2,200 net even after the cost, and that's before you factor income tax effects. But watch what happens when we slide that profit number down. Less profit means a smaller distribution, which means smaller savings, while the costs barely move. At some point, the two lines meet, and that crossing point is the whole decision. Here's the savings at different profit levels against a flat $2,000 cost. To keep it apples to apples, every point assumes the same split as our example, about 62% of profit as salary, the rest as a distribution. At $40,000 in profit, that sensible salary eats up most of it. The distribution is small, and the SE tax savings land right around $2,100, basically a wash. At $30,000, you're underwater. You'd pay more to run the S-Corp than it saves. At 60, 80, 100,000, the savings pool clearly ahead. So the rule of thumb you can actually use. Somewhere around $40,000 to $50,000 of net profit is where an S-Corp starts to pay for itself. Below that, the compliance cost eats the savings, and you've taken on payroll, an extra tax return, and paperwork for nothing. Above it, every additional dollar of profit widens the gap in your favor. And let's be honest about the threshold itself. It isn't a hard cliff. It slides with how high a salary you have to pay yourself, what your state charges, and what your CPA costs. A pricier state or a high required salary pushes your break-even up towards $60,000. Remember too, the 12.4% Social Security piece only applies up to the wage base, $184,500 for 2026, above which just the 2.9% Medicare piece remains. The takeaway isn't a magic number, it's that there is a line, and you should know which side of it you're standing on before you elect. Let's put them head to head. A plain LLC, really taxed as a sole proprietor, is simple. No payroll, one tax return, near zero overhead, and you pay self-employment tax on everything. An S-Corp adds payroll, a second return, and real cost, but carves out that distribution from SE tax. One is cheap and simple. The other is more work that pays off only once your profit is high enough to clear the cost. Here's the honest part most hype videos skip. The S-Corp isn't the winner, it's situational. For a freelancer netting 30 or 40,000, the plain LLC is genuinely the smarter pick. For someone steadily clearing 80 or 100, the S-Corp can save thousands a year, and it'd be leaving money on the table not to look at it. Same tool, opposite answers, depending entirely on your number. There's no trophy here, just a fit. So, the whole video in 4 lines. 1. An S-Corp is a tax election that lets part of your profit skip the 15.3% SE tax, which applies to 92.35% of your net earnings. 2. It costs roughly $1,500 to $3,000 a year to run no matter what. 3. The break-even cites around $40,000 to $50,000 of net profit. Below it, you lose. Above it, you win. And 4, if you're under that line, the answer is not yet. Stay a simple LLC and revisit when your profit climbs. If you're comfortably over it, take this math to a CPA and run your exact numbers. If you found your number today, you're already ahead of most people getting this advice from a 30-second clip. One last reminder, these are illustrative 2026 figures. Your state, your salary, and a Form 2-553 election deadline all matter, so this isn't financial advice. Confirm with a CPA. Next up, we break down the reasonable salary question on its own, how to set yours so it survives an audit and still maximizes the split. Subscribe so the math finds you before the hype does. We'll see you in the next one.